Dear students, welcome to video 1 in a series of videos which will look at topic 5, Sources of Finance. Sources of Finance is our last module in financial management. Throughout the course of the next number of videos, we will be looking at the sources of finance available to a business both internally within the organisation and externally outside of the organisation. From an exam perspective, sources of finance will appear in two sections. Section A, the multiple choice questions, where there will be at least 4 sources of finance questions, and then again in Section B. In Section B, sources of finance will not be a standalone question, rather will be mixed with another topic we have completed throughout the semester. Let's take a look at sources of finance without further ado. Throughout the next number of videos, we will first of all start with looking at some general terms. We will then look at the internal sources of finance available to an organisation, both in the short term and the long term. We will then move on to external sources of finance, looking at short-term funding, medium-term funding, and long-term funding. We will conclude this topic by looking at the sources of finance available through the stock exchange, i.e. listing an organisation on a stock exchange makes the organisation publicly listed where individuals in the general public can invest in the organisation. So, some general terms. One of the primary functions of the finance manager is that of the fundraiser. We looked at the role and the task of the finance manager during topic 1. If this is not known to you, I would highly recommend that you go back to topic 1 and look at the roles and the tasks of the finance manager. In performing their roles and tasks, it is the responsibility of the finance manager to find the right type of finance, from the right place, and at the right time. There are many different sources of finance available to organisations in the short term, the medium term, and the long term. It is very, very important that you are able to differentiate between short, medium, and long-term sources of finance. In respect of short-term finance, this is the source of finance that is due to be repaid in a period less than 1 year, i.e. within a 12-month period. Secondly, we have a medium-term source of finance. This finance is due for repayment in 1 to 5 years. And then finally, a long-term source of finance is due to be repaid in 5 years' time. Please ensure you know the difference between short, medium, and long-term sources of finance. Each source of finance affects the business in 3 distinct ways, in respect of risk, income, and control. Let's take a look at risk first. The risk is that the business will not be able to meet the financial commitments relating to the source, so i.e. the finance that they've taken out. The risk might be that they do not have the cash resources to repay the loan within the specific period of time, or to meet the interest repayments. Income is the second source. Income is the cost of the funds. So if you think about it, if you go down to Bank of Ireland or your local credit union or AIB or any financial institution and you take out a term loan, that particular financial institution does not give you that source of finance for free. There's a cost associated with that source of funds, and it's typically in respect of interest. The use of one source of finance may affect the cost of another. So for example, using debt may increase the cost of equity. And thirdly then is control. With some methods, the company will give up control over the business, whereby an individual who is investing in a business or providing a source of finance will want an element of control associated with that business. Those are 3 distinct ways in which the source of finance that an organisation takes will be dependent on. So risk, income, and control. Therefore, it is the financial manager's job to provide the required finance at minimum risk, with minimum loss of control, while maximising the wealth of the owners. So, i.e., to identify a source of finance that is relatively cheap for the organisation in order to maintain shareholders' wealth within the organisation. It's a very difficult task for many reasons, particularly due to the range of sources of finance available, not only from an individual perspective, but this has been heightened in an organisational perspective where you have a greater degree of finance available. So some of the finance can be categorised into internal and external. In respect of internal, it can be short-term or long-term. In respect of external, it can be short, medium or long-term. So without further ado, let's take a look at internal sources of finance. The characteristics of internal sources of finance include: it arises from management decisions only, agreements required only from directors and managers, it does not require permission from other parties, it provides flexibility, and it can be obtained easily and quickly. So let's take a look at some of the internal sources of finance that are available. In the short term, we can avail of tighter credit control with our customers. So i.e., instead of providing 60 days credit, we only provide 30 days credit. We can reduce the stock levels. We can delay our payments to our creditors. We can create accruals or deferred income. And then long term, we can use our retained earnings. Let's take a look at each of these in turn. So tighter credit control is to have less funds tied up in our debtors or accounts receivable. We looked at this in detail in topic 2. In order to obtain our cash or the money faster from our customers, we must ensure that accounts are promptly followed up. We must consider customer requirements and credit practices of our competitors. We discussed this in respect of topic 2, but very briefly, if our competitors are providing 60 days credit and we will only provide our customers with 30 days credit, this may result in a loss of customers. The advantage in respect of this source of finance is that there's less risk of bad debts, so i.e. that the customers will default on payment, and it leads to better cash flow. Disadvantages: there's a risk of a loss of sales, and there's a risk of a loss of customer goodwill also. Reducing inventory levels. This is holding the minimum level of stock so that funds are released for other use. We looked at the management of inventory during topic 2, particularly the EOQ. The advantages of holding minimum levels of stock include reducing the risk of obsolescence, lower stock holding costs, i.e. the cost of holding inventory in our warehouse, and also better cash flow. The disadvantages is there's a risk of loss of sales if stock is unavailable when the customer looks for the item, risk of a loss of customer goodwill through an inability to fill orders, and it may require a large investment in IT to manage the system. Thirdly, we have delaying payments to our creditors or accounts payable. Businesses can avail of trade credit, i.e. buy goods now and pay later. To avail of this source of finance, suppliers are paid at the last possible moment in order to retain funds within the business as long as possible. The advantages is it's a cheap source of finance, as it typically is interest-free. It's available to most buyers who make regular purchases. Only review periodically once it's initiated with a particular supplier. It can be stretched in times of crisis, and it's an important source of finance for all businesses. Disadvantages associated with delaying payments to our creditors include interest may be charged on overdue accounts, which ultimately leads to an additional cost for the organisation. Discounts may be lost that would have been availed of if we could have paid within a faster period of time. There's risk of alienating our suppliers. There's a possible loss of credit facilities, and it may give rise to a bad reputation within the sector that we're operating in if we are continuously stretching our credit limits with our own suppliers. In respect of accrued expenses, this is where an expense has been incurred but has not been paid for. Payment is delayed for as long as possible in order to enjoy maximum use of the funds. So for example, electricity is a typical accrual an organisation would have, or salaries or tax or PRSI. However, it normally does involve small amounts of monies. The advantage is it's a costless source of finance. It's holding money within the organisation until those expenses must be paid. Disadvantages: interest may be incurred on overdue payments. There may be a loss of confidence in the operating capacity of the business. dissatisfaction from our employees, and it can give rise to a bad reputation if we are not paying our bills within the required period of time. Deferred income, then, is another source of internal funding. Customers are asked to pay for some or all of the invoiced amount in advance before they receive the product or service, as it can reduce the risk of non-payment of debt. However, deferred income will only work in particular industries or sectors. So, for example, if we take a typical retail organisation such as Penneys, if Penneys asked us to pay in advance for in 1 month for products we would receive in the following month, we may be less inclined to avail of that source of finance. Again, deferred income, it typically applies to big organisations where they have contracts with customers. So, for example, the construction sector. The next source of finance available is long-term, retained earnings. Retained earnings involves maintaining funds within the business. So, for example, every year an organisation generates a profit. That profit then automatically transfers to the retained earnings at the end of the year. In order to avail of retained earnings as a source of finance, the organisation or the finance manager must maintain those funds within the business. So, for example, they might not pay out a dividend to the shareholders as a way of retaining funds within the organisation to help it to improve and grow. The advantage of this source of finance is that there is no issue costs, so no new shares are issued. It's an easy access to funds. It's already available within the organisation. There's no effect on control. It helps to reduce the financial risk, so i.e. lowers the gearing ratio. Remember, the gearing ratio is our debt to equity proportion. So in using funds from equity, i.e. our retained earnings, we are not increasing our gearing ratio. In addition to this, there's no fixed maturity. Equity is a permanent source of finance. There are, however, some disadvantages of using retained earnings as a source of finance. Management may not be careful with funds as they would have been if the funds were raised elsewhere. That gives rise to an agency problem. Okay, if you think about an organisation that has to source their funds externally, maybe from a bank, the managers then become accountable to that financial institution. This is not the case if the funding is generated from retained earnings. It may deter potential investors. Shareholders may require a higher rate of return in subsequent years, particularly if management have decided not to pay out a dividend in the current year. It can be difficult to plan the timing and the amount of profits, as it may be difficult to estimate for the management. That now concludes video 1 for sources of finance. In video 2, we will commence looking at external sources of finance available to the organisation in both short, medium and long term. Thank you for listening.